Want you in mutual funds and variable annuities. Hopefully by now you've gotten a lot of education and some basics on what we're going to be talking about at our class. But now for one of the biggest problems that retirees will face, losing much of their cash flow and income to fees. Now before I get into why the financial industry wants you in these types of products, let's go back a little bit in the history books. What has happened over the last 20 to 30 years? Well, 30 years ago, there were only stockbrokers and insurance agents. Now, when the internet evolved, it created online discount brokers. And when people could buy stocks for as little as $5 per trade, it put the stockbrokers out of business. So to survive, the brokerage industry changed gears to sell mutual funds and variable annuities. They could earn 2 to 4 times as much as a stock trade. Now, what happens is that the fees and expenses are so buried within that prospectus and what you actually are paying, it makes it almost impossible to figure out what you really have. So what we're going to do is we're going to go to a little place called personalfund.com. And this is kind of like the consumer reports for mutual funds. And let's type in a fund, or let's go find a fund that might have fees that differ from what they actually are telling you in the prospectus. Now, I know that a lot of people will go to something like a Morningstar. They'll look up Morningstar and they'll say, okay, what are my actual fees in this thing? But that doesn't really account for a lot of the fees that a person might really pay. It doesn't include a lot of the what's called 12B1 fees. It doesn't include, say, the administrative or trading cost fees. So there's a lot of fees that aren't always included. Now, what I'm going to do is, and you're free to go to personalfund.com. It's a great little place. Now, once you get past 3 analysis, then they will start charging you for the service, the membership. But what I'm going to do is I'm going to input, I just looked up this one here, Franklin Templeton Fund Allocator Series, Class C shares. Let's take a look at this and see what they actually are charging. Isn't that interesting? Look at this, 2.6%. So in other words, on an average basis from what the prospectus says, now here's what it says. The average prospectus says it's 1.34%. And let's say for the heck of it, let's go try another fund company. Let's try American Funds. And usually when we do this on the radio show, we have people call in tickers. So what we'll do here is I'll just pick a favorite fund here. Let's pick this one, and we'll use the same numbers as I did with the Franklin. 10,000 in, taxable account, hold it for 5 years. I don't think that'll get 12% rate of return. That's a little bit high. And assuming you're only in a 25% tax bracket. Oh, there you go. Look at that. 3.14%. Now let me show you what this analysis is really saying. The prospectus for this particular fund shows, let's find it here. Here's the 12B1 fee is 0.24. The total expense ratio is 0.70, but you have to pay 5.75% just to get in. So if you give them $10,000, you're giving them $575 right out of the gate just to buy into that fund. Okay, it's like a cover charge to get into the bar. And let's go back here. So you can see it's 3.14% is the last year's cost of ownership. And let's take a look at this one here. This is a close runner because what this program will do is it will say, okay, what did they actually provide in investments? And let's find a couple other companies that might do the same thing. So here's Growth Fund of America. This program suggests that principal funds, large cap, or Schwab Strategic Trust can do pretty much the same thing that Growth Fund of America does, but they can do it without a front load. And you can see here, they do it for a much lesser fee per year. So I think what you just learned from that is you really have to be careful, know where to look for the actual expenses because they're not going to always tell you that in the fund prospectus. Now here's some other things why I don't agree with mutual funds. Now these are open-ended mutual funds. The managers only need to invest 65% to their objective. So imagine you go buy a medium-term bond fund thinking, hey, I'm in my retirement, I'm going to do something a little bit safer. And you find out later on that the thing drops like a rock. And one of the reasons is that the manager actually invested 65% in what he was allowed to invest in, but the other 35% maybe went into gold or commodities or some other goofy thing. Number 3 is you're going to pay taxes on the capital gains even if your fund loses money. That's one of the big downsides to a mutual fund. And you cannot talk to or work with the manager. The difference is when you're working with an independent manager, you can actually maneuver taxation around, you can maneuver risk around better than you ever could hope to do with a mutual fund. And the other big problem is you can only sell at the end of the day. That does not allow you to put in any stop losses. It does not allow you to put any calls on it. It does not allow any type of normal market strategies on a mutual fund. Those are reserved only for the manager. Now, what about variable annuities? Well, the favorite product of the financial advisor is, in fact, the variable annuity. One of the reasons I do not like them is there's multiple. I mean, when you take a look at what the total amount of expenses are within a variable annuities, it's enough to choke a horse. Look, you got mutual fund fees within that variable annuity, anywhere between 0.5% to 1.5%. Then they add on an additional mortality and expense fee. I usually see between 1.5% and 2.5%. So the average fees are exceeding 2.5%. Now, number 2 is you lose your capital gains tax treatments. All capital gains are converted to ordinary income. Now, you will hear a lot of times, yes, but if I put my money into a variable annuity, I'll never lose money. That's true, but you would have to die to get that guarantee. We're talking about making sure that you survive while you're alive. Now, my question is the truth. Has your financial advisor gone through all your funds with you and outlined your real fees, risks, and real performance? You should know what the difference between arithmetic and geometric performance is at this point. Has your broker or financial advisor tried to sell you on open-ended mutual funds or managing a mutual fund portfolio or variable annuity? At the class, we're going to give you some ways to really check what your fees, performance, and risk are.